I want to bring in Diana Avigdor, head of trading at Barometer Capital Management. Diana, great to see you. And just place for me your thoughts on those things, right? We've got this massive move of retail trading, some of the smart money on the sidelines worried about the fundamentals here. What do you see happening out there? What's moving markets?
That's exactly two things. One is this retail participation that you mentioned earlier. It does create a lot of headlines and a lot more than actual volume shows in the market. Retail volume is still about only 2 to 3% of the total volume, but there certainly has been very, very loud noise. But we do have a central bank that is very intent on making sure that everybody knows that they have your back. Almost on a daily basis, you have somebody coming out and making some comments on this facility, that facility, this investment that they're going to participate in, and or that. Just making sure that nothing comes unglued here while the reopening of the economy happens. And to your point, you mentioned earlier, it's difficult to place a valuation on the market. Some will say expensive, and some will say, I just don't know, as the earnings of the market in aggregate is still yet unknown as to how the reopening and what actually going to happen in terms of actual earnings for the companies. In my opinion, the market is a little bit overextended in the short term, but of course is backstopped by a lot of central bank liquidity, some retail that's pulling in quantitative strategy investments that tend to be price insensitive. And while volatility was subdued over the recent rally, it has now picked up again, putting these quantitative strategies a bit on the sidelines, thereby taking out one of the big, more aggressive buyers out of the market. So I do think that this market is due for a bit of a pause short term.
It is also, we are reminded, quadruple witching this week, the quadruple expiration of contracts on Friday. We see a lot of volatility and move around that. Do you see that happening all week long? In other words, is that some of the kind of positioning we're seeing in the market here?
Yeah, so the quad witch, as they call it, happens this Friday, and it's a very, very big expiry. In other words, there's a lot of open interest on a lot of the S&P and index options, and they're coming due. And we also have an S&P index rebalance this Friday, and the previous quarter rebalance was extended to now. It was canceled last quarter because of the way the markets were acting. So there's lots of extra moves that expected to happen into this index rebalance. And it doesn't happen exactly on Friday. There's a lot of pre-trading, pre-positioning, because there is a lot of volume that needs to go through. Something about $50 billion worth of moves, or $50 billion worth of merchandise that needs to change hands, either in or out into this rebalance. It tends to create a lot of noise, a lot of buzzing, a lot of intraday volatility, but it tends to pin the market into a directionless couple of days here. Once that finishes into next week, we have the week after, we have a Russell rebalance, which is also very big, a lot of merchandise, kind of tends to pin the market in a range, but with very, very noisy up and down. And so that's probably what happens in the next 5 to 10 trading days. And then afterwards, we'll see.
Obviously, Diana, one of the big unknowns, the Prime Minister alluded to it in his reluctance to call the fiscal update a fiscal update. It's hard to know, to forecast what's going to happen, because one of the big things we don't know is whether there'll be a setback in the pandemic on the health front, and whether we'll have to see closures again. We're seeing some bad news on that front. I mean, there've been kind of spottiness in the U.S. About the rate of new cases across the U.S. We saw Beijing closing its schools yesterday. How do you factor in the potential negativity when it's so hard to know what's going to happen?
That's That's an excellent comment, Amanda, and I'm scratching my head. The market seems to be ignoring. The market will power ahead and ignore all the bad news for as long as it wants to go up, and then eventually everything. But this is one of the reasons I think that we're a little overextended here, and the market is being held up by, call it perhaps not so fundamental forces. Yes, there is the hope of reopening. And about the COVID, I feel like the sensitivity to the numbers has decreased as we have realized. The closing was to support and help the hospital capacity. The fear was that sick people would not get care that would save their lives because of lack of hospital capacity. And so less attention is being put on the numbers and more on hospital capacity, and that seems to be okay. Even the numbers, hospitalization numbers that we've seen out of Texas, which is pretty high, and what you said in Shanghai, hospital capacity remains in good shape. And so to the extent that you get proper care and lives are saved, that's encouraging. But the numbers are going up, and this is exactly why I mentioned earlier that the opening, we're opening, but we don't know to what extent people are going to go into that restaurant that just opened, especially that it opens at 50% capacity. And then is it even going to get their 50% capacity? And how are they going to survive on that? And from our investment perspective, we want to avoid those areas and just invest in companies that are able to navigate through this unknown environment.
Just in terms of the sectors that you think are the safest here, are there places you're looking that you just think that there's value almost regardless of what happens from here?
So, yeah, in our portfolio, given the unknown in the world and the way the markets are reacting, we are more diversified than we have been in, say, times where we had more visibility. We have a decent weight in technology, which tends to benefit either way. We're currently at about 30% weight technology. We have been known to overweight sectors much more than this. We have some golds which act as a hedge, and we see that today it's working. In terms of the technology, for example, we've always liked semis as an industry, but especially data center exposure, which support the rapid shift and growth in cloud. Intel, for example, has 90% of market share currently. Processing capacity is very important as we use more and more technology stuff. And they also benefit from the huge spend on the PC side to build out the work from home capacity. Another sector is, believe it or not, retail. Things like Lululemon, Nike, they have built out robust direct-to-consumer sales channels, best-of-breed retail and websites, secular tailwind as there is shift to athletic leisure wear, and they also benefit from the opening of life, gyms, and so forth.
All right, we got to leave it there. Diana, great to have you with us. Appreciate your time. Diana Avigdor is head of trading at Barometer Capital Management.